Welcome to the Educated Homebuyer Live San Antonio edition, Josh. I
That's
am
it's a
here in the
50
lovely
50% San Antonio edition.
50% San Antonio. You're still in Southern California. We're back here to once again update you on what's happening in the economy, answer your mortgage and real estate related questions, and also talk about house prices declining through 2026. So, Josh, since last week, we've had a lot of volatility in the market, probably one of the more chaotic weeks we've had. And it seems like we're seeing that more and more often. But we've seen some negativity, we've seen some positivity. Did we end up more or less the same as where we were last week? What's going on?
That's 100%. I was sitting here earlier today and I was like, this is ridiculous. Things are just bad. And they're not bad. It's just it goes from you have a day where it's really bad and then a couple days where it gets back. And then you look at the end of the week and you're like, utter chaos and round trips to nowhere. So that's what we have. Just we're on a road to nowhere. For those of you who are not old like me, you probably don't remember Talking Heads, but that's that song just playing through my head.
Josh, we are talking heads, and that's exactly what we're doing here. So, as we start doing our talking head piece here, guys, do us a favor. Let us know where you're watching from. Start putting your questions in the chat so that when we're done, we can flow right out of this. I'm not sure how many of you are watching now. We're actually at the first time homebuyer seminar webinar that we did last night. Had a great turnout. Provided a lot of valuable information. And so hopefully, those of you who are there really found value in it. And those of you who weren't, we're going to be doing another one probably in the next quarter, which we'll be putting out here, in the next couple of weeks to let you, to keep you up to date on what's happening out there. But let's do what we always do, Josh, and start looking at some charts. So we want to start with the Zillow forecast, right? This is getting a lot of news out there, Josh, making the headlines. I mean, it made the title of our video to some extent. That Zillow's forecasting a decline in home prices from March of this year to March of next year. But what are we talking about here? We're talking about a decline of 1.7% in median home price. So what are your thoughts?
If you look at this chart is batshit crazy. The thing that I like to point out to people with Zillow, it's really truly more of a nowcast. It is data based. This isn't. They're not. A lot of the things that we show is the like CoreLogic's economists project this. So they're looking at data, but then they're making an educated, informed guess as to where things are going to go. Zillow is really data based, and it's the data that happened most recently, like in the last 30 days. So they weight that super heavily. And the problem is what you and I just talked about, Jeb, we don't know. We don't know what happens tomorrow. We don't know what happens next week. And no one ever has a crystal ball, but you generally have an idea. You have a trajectory. We have unprecedented levels of uncertainty. So this nowcast has sort of absorbed this idea of rates being higher. So meaning high sixes, low sevens, whereas, 6-8 weeks ago, it was looking like we were trending to the mid to low sixes. And it sounds like a distinction without a difference there, but there's a really big difference. And that difference is, probably 200,000 or 300,000 sales across the course of a year. And then the trajectory being flat, 1% growth or 3 or 4%. I mean, nothing is going to happen. If rates drop to 5.5%, I don't think we see 10% home price appreciation. If rates go to 9%, maybe you see a 5 or 10% drop. But looking at the chart, Jeb, the chart is the craziest thing here that there's no blue on there. And we know the almost the entire Northeast, anyone shopping right there right now is having an issue getting a property under contract, multiple bid situations, paying over list, all that stuff.
But what's funny is in Resi Club's information, which I put in the video that I published today on a new channel that I've created out there. They actually do have some areas that show positive appreciation. It's not going to be 8%, but it was in the 2 to 3% range. But most of it was located in the Northeast. So I can't tell from this chart just based on the size of it whether
there's a couple of tiny little ones that say Hartford plus 0.7,
Yeah.
Rochester plus 1.8. There's like 10 little tiny dots up there.
Well,
and I know we deal with a lot of customers up there and borrowers, and they're having a hard time getting homes under contract. If you want to tell me what they're saying here along the Gulf Coast states and a little bit of Texas, but that is wall to wall negative for the entire country. And that's just not going to happen.
No, understood. So let's do just kind of let this roll into inventory because what drives markets is supply and demand. And at the moment, Josh, we're seeing an increase in supply. We're sitting 32.5% higher in inventory than we were last year. We saw an increase of 17,000 single family homes, which is the biggest gain in a weekly gain that we've seen in almost 3 years. So we've seen more properties come to the market this past week than the last 3 years in any given week. So big increase there. Which, take us into looking at this data, which, we went from 702,000 up to 719. Again, our peak last year was at 739. So my guess is within the next 2 weeks, we're above where we were last year. And I think the expectation at the moment, based on what I've been reading, is that we're going to end somewhere, 2025 is the expectation, somewhere around 850,000 single family homes on the market. So give or take, we'll find out what that looks like. I think a lot of it depends on interest rates, as we've discussed many times. But for now, the story is more property coming to the market. We're seeing it here in Orange County, 4,012 homes on the market, which is an increase of 2.59%. Huntington Beach sitting at 273. That's a just over 4% increase week over week. So inventory is growing basically across the board. And taking us into looking at weekly sellers here. So 77,000 new listings this week, 12% more than last year. And there were only 15,000 immediate sales. So in total growth, 4% more each week than a year ago. So again, it's the same story across the board. And that's going to put us into talking about the idea, can growth in home sales actually keep up? So let's talk about weekly pending home sales. 72,000 home started for single family homes this week. That's basically unchanged for the week and just a fraction higher than where we were a year ago. But next week's going to include the Easter weekend data. So there's a chance you see a small decline just because of where Easter falls. And you can kind of see it last year. Easter was earlier in the year. You see that drop there in new listings. Probably correlates here. Easter changes every single year. It's not on the same Sunday. In fact, Josh, I had to look up how Easter, why. And it was the first full moon after something. And I was like, what are we talking about here? So, but anyway, did you know that?
I did not.
Yeah.
I'm sure it's one of those ones that we all knew at some point.
It's the first full moon after something. And I forget what it was, but it can range anywhere from March 23rd, I think, to April 25th. Dude, crazy. I had no idea. I'm
it's a wide range. As far as all of the holidays, that one is far and away the widest range of when it can show up.
But then let us look at median home price. So median home price currently sitting at $399,000 for homes going into contract, basically unchanged from last year and or from last week rather, and just fractionally higher than last year. And then when we look at price cut sitting at 35.6%, which is somewhat plateaued here over the last month or so. We're seeing small climbs, but nothing big. So we will see what that continues to look like, Josh. But my guess is as rates stay high, you're going to see more and more people doing price cuts. New home sales, Josh. So why do new home sales actually matter? We saw a jump in new home sales.
Well, it's funny. Our friend Diana Olick over at CNBC said it doesn't matter. It's terrible. Shockingly, she's always able to spin everything into bad news. We had bad weather in January and February, so there's some push forward effect. People weren't able to get out and buy. And I don't know if these are actually measures of going under contract or closing, but most likely under contracts. People just aren't out looking at homes, putting things under contract. It's a positive sign when they're above expectations. We're above where we were last year. Some of this reflects that rates were lower 6 weeks ago. So you had hinted at, hey, if rates stay higher, it's funny. There are people in the comment section who get hung up on, well, you guys are always talking about interest rates. It's really about prices. Okay, well, the direction of prices is going to be impacted, and basically the cause and effect there is the affordability, which is getting pushed by interest rates. So if rates stay up, then you see downward pressure on prices and sales volume, and vice versa. If we see interest rates dip, every time we've seen them dip, you see the numbers beat. Are they beating by a lot? No, but we're also not seeing interest rates beat by a lot either. They're a little bit better than expectations, and it brings more people out of the woods. The thing that's interesting right now, Jeb, we talk about the uncertainty volatility. Who knows what happens tomorrow, next week, next month with interest rates, but just everything. People in uncertain times just don't act. Why make a decision when there's uncertainty? You want to wait until there's more certainty. So we need our current president to help out in terms of additional certainty versus continuing to just have chaos. And in these slides here, I have got a few things to just kind of point out what we're dealing with on a day-to-day basis and why the volatility we're seeing is not surprising in light of this. But you threw this one in here, Jeb.
Yeah, I just think it's interesting to take a look at it. I mean, this is home price appreciation nationwide going back, what, 50, 74 years? I thought it was interesting to take a look at. Nationwide, you've only had, what, 7 times where nationwide home prices actually dipped. But we talk about, does it matter? Do you care if you're located in Southern California, what's happening in, North Carolina? Chances are you don't, unless there's some direct correlation there, unless you have a property there or family does or something else. It doesn't really matter what's happening. So even though you're seeing positive growth year over year, there are some areas that are probably going to see some small declines this year, but that's probably not going to be the nationwide story. So just again, you take it with a grain of salt, but make sure you're paying more attention to local data than you are nationwide data.
That data, so a couple things to point out. That data is from Robert Shiller. So the Case-Shiller index, it's a paired sales index. It is much better than median figures. But going into 2005, 2006, the media liked to say, we have nothing to fear. We've never had a year where on a nationwide basis, home prices have dropped. And again, you're not buying a basket of homes nationwide, you're buying a local home. And we absolutely have had many, many times where local markets have dipped for different reasons. I almost threw it in, Jeb, but I ran out of time here. There's been a lot of attention. The Wall Street Journal ran another article. They've just been all over condos, but talking about condo listings piling up in Florida. And you look, and another newsletter that you get every week that you share with me, the guy throws in, he's looking at employment figures for Florida and Texas. And we have not seen any worsening of employment conditions in either Florida or Texas, yet we're seeing some weakness in those markets. So this isn't telling us that there's an issue with the economy. Those markets are having a lower net in-migration than what they had over the last many years. And you have an affordability issue in that those markets appreciated more than other markets. So it's kind of interesting seeing what and why these things are correcting. But definitely, I wouldn't weigh too heavily what's happening with the condo markets, especially Florida condos. This one, Jeb, I thought was super interesting. In October of last year, The Economist did America's Economy, a special report. We are the envy of the world. The world is in neutral or worse, and the U.S. economy is just wonderful. Now here we are in April. So what is that? Almost exactly 6 months later, how a dollar crisis would unfold. I think it is important to note The Economist is not the clickbaitiest of news media out there, but they want eyeballs. They want attention.
Sure.
In October, was the economy as good as what this cover would lead you to believe? No. This dollar crisis, people rotating out of the US dollar, people are going to be getting out of treasuries, all of these things. We can go back about 5 different times in my 30 years in this business that we've heard that same narrative told. I think everyone needs to step back and look at that. We have not really seen that much of a correction in stocks in the big picture because we've had, some really bad days, day-to-day volatility, but then some really good days mixed in. So the overall is negative, but not nearly as bad as people think. I think we're going to get, 6, 12, 24 months into the future and realize that people were far too focused on one tweet to the next versus what was actually happening. And on that, you and I, Jeb, got to enjoy this one this week. So this was on the 17th. Trump lashes out at Powell, says termination cannot come fast enough. We were fortunate that was last Thursday. So the market was closed for half the day on Thursday, closed for Good Friday. And we didn't really get to see the little tantrum in the markets until Monday. The markets don't like this. They don't want one person, whether it's the president, the King of England, whoever, anywhere in the world, to be able to say, hey, you know what? I would like lower interest rates. Like the Fed, dislike the Fed, hate the Fed. The fact that it is a committee, the greatest weight in the room is put on the chairman, but the chairman has an appointment that can't be fired. He cannot be fired. Trump may believe that he does, but Jeb, this was what made us chuckle yesterday, the 22nd. Trump now has no intention. I don't know where you guys got this crazy idea, but this is now 2 times when he said things that very clearly upset the market and then rapidly walked them back 180 degrees. So like him or hate him, this is a reason to like him even less. But even those of you who are big Trump supporters, he's not doing himself or the markets or the U.S. economy any favors. I feel, I don't know about you, Jeb, but I feel like we're pretty lucky to be where we're at, despite all of the chaos. Big picture, we've been following it more than we usually do, because again, this is a nowcast, but this is for Q1. We are past Q1. We are, I think, a week or so away, Jeb, from getting the first preliminary look.
Yep.
So next week we get the first preliminary look. It gets revised twice. It is looking like it is going to be negative. So the dark green line, there was so much gold buying in the first quarter that they had to put these adjustments in there. And the dashed green line there is their best adjustment for all of the gold buying that was done. And it looks like we're slightly negative for Q1. So we'll see. I think it's over 6-8 weeks. We're going to get an announcement and 2 revisions, but likely to see at least the first quarter had negative GDP growth, largely because of all the uncertainty out there. Normally we show you trends here with this. We'll have a channel up, a channel down in terms of yields and interest rates. We are in this sort of sideways movement, but we've been down to the bottom side right after Liberation Day, and then out to the high side a couple of weeks ago, and now just sort of trending in the high end of that. So it'll be interesting to see what comes next. In terms of interest rates, you asked, Jeb, tiny improvement over yesterday, but at the best levels today, there was a pretty big improvement, probably 1/8% versus 0.04%. Over the week, a tiny little bit worse, and over the month, rates are about 1/4% worse, which doesn't sound like a lot, but 6.7 versus 6.94, 6.75 versus 6.94, it makes a difference. With $400,000, $500,000, $600,000 entry-level homes that a lot of you are looking at, it makes a significant difference. I wanted to throw this in here because you can look and say, if we go, the peak last year was almost exactly 1 year ago, 7.52, and came all the way down to 6.11, and now we're at 6.94. So that's a pretty big range. It's a 1.4% range from high to low, and we're just about the middle of it. So I feel like where we're at right now isn't a huge break on the market, but it's certainly not a tailwind. We need to make a move to the lower 6s, high 5s, if we're going to see an increase in sales volume and continued increases in home prices, or you get what Zillow is predicting right now of that 1.4% nationwide downturn.
Yeah. And if you're watching right now, I posted a video this week about Mr. Cooper loans. If you have a Mr. Cooper loan, or you don't, it doesn't really matter. But the idea here is that if you have one, there's probably some incentives coming out there to help you get a lower rate than what the market's offering. And one way to do that is getting on the rate watch. And rates probably aren't in a position at the moment for you to actually take advantage of a lower rate. I mean, even if you got 1/4%, rates are still in the high 6s. So, but the idea here is that rates are going to trend down, especially as the economy softens. That said, if you're interested in refinancing, get on a list. It doesn't have to be our list, but get on somebody's rate watch list so that they can reach out to you and let you know when rates drop, so that you don't have to watch this every day like Josh and I do and bang your head against the wall continuously. Because trust me, my head is sore from banging it continuously against the wall. So anyhow, you can do that, jebsmith.net/rate watch. And the last thing I'll say is, if you'd like to get in touch with Josh or myself, there is a link scrolling at the bottom of the screen, jebsmith.net/start, and we can help guide you through the home buying process. Josh can help you with the pre-approval process, give you a second quote, all of that good stuff. So, Mr. Josh, this week we talked about FHA loans on the podcast, kind of gave a different spin on it. If you're thinking FHA loans, you haven't checked out that podcast, go over to the Educated HomeBuyer and do so. But we don't really have a lot of questions here, Josh. We do have a question about the idea of recasting versus refinancing. But before we do that, I think we should just say hi to Dixieland from Minnesota, Patrick from Georgia, Chris from Orange County, Kimberly from LaGrange, and Heather from Inglewood. A lot of California in the house today. And if you haven't let us know where you're watching from, please do so. But Josh, what's the difference? There you go, Westlake Village, another California. What's the difference between recasting and refinancing?
So a recast happens when you make a large principal payment. So you have a $400,000 loan at 7% and you make a $100,000 principal reduction. Now you have a $300,000 loan. With a fixed rate loan, that does not adjust the monthly payment. You will continue making the higher payment, just more is going to go to principal because now you have a 25% smaller loan every month. So you're accruing less interest, but making the same payment. So effectively from there forward, you're making a larger principal payment or a principal reduction payment every month. So it shortens the term. Many people, when they make that large $100,000 principal pay down, what they're looking for is a lower monthly payment. So you can reach out to your lender. You can ask them, hey, can I have this recast? Because where we are in the current market, a lot of you have 3%, 4%, 4.5%, 5% mortgage rates. So what was happening, when rates were on the steady decline, if your lender didn't want to do the recast or you didn't know about a recast, we would just say, hey, let's do a cash in refinance, get you a new loan at a lower interest rate for $300,000, resets the payment back where you want it. So a recast is only possible if you make a large principal reduction. Refinance is possible for anyone who could benefit from a lower interest rate.
All right, good stuff. A couple more jumped in here, Josh. We got miscellaneous of the whatever in Vegas. We got Woodbridge, Virginia in the house. And then we got Jay asking, when should we hold till? But then I'm not sure what that means, but when is a good time to buy, get in? I'm taking this as when is a good time to buy? Is that?
Yeah. It's a false premise. It's saying that there is someone, Jeb, Josh, you, who has insight into this optimal time. If you are thinking, saw a comment on one of our videos today, Jeb, I'm just waiting to buy in. I'm just waiting for a better entry point. I got $200,000. Like, you could be waiting a long time. Maybe you're right. And maybe in a year, prices are 10% lower. There's nothing coming along that sees that. But what I think, what Jeb thinks, what anyone else thinks doesn't matter. It only matters what you think. Look at the data. Look at your market. I mean, let's say you are in the market for a condo in Southwest Florida. I would say I would hold on and get some more clarity on what's coming. If I'm in Bristol, Connecticut, and it's a very tight market and I want to get in, I probably would want to jump in now. So I guess I'm going to revert to two things. The time is right when it is right for you, and you've done your research on your local market and you believe it is a good time for you to enter. Because I don't think anyone can tell you there's some optimal point. Other things being equal, the earliest that it makes positive sense for you and you're comfortable with it.
Good stuff. I don't really think I have much to add there. We have LC from San Jose. We got the Catholic Misfit from Tucson, from Tucson. I always say Tucson. That's Landon's
It's more
soccer
fun.
coach.
It's more fun.
Tucson. It was hilarious. Like, nobody knew what he was talking about the day that he said we were going to play a soccer tournament there. Anyhow, let's go up here. We got Joyce, Josh. We talked about this today, Joyce, regarding the home buying webinar that we did yesterday. Will we be able to see a video recording on it? So, Josh, are we going to put that out there, or are we holding that to the chest and only people that show up get it?
No, one way or the other, we're going to make it available to you. The question is, and maybe you guys tell us what your thoughts are. We've thought about putting it out as an episode of the podcast. We also can post a replay link where you can register and see it. So one way or the other, it'll be available. We're just working on finishing up some of the bonuses. We have a couple of really, what I think are really good bonuses that we put together, some PDF handouts that are going to be great for anyone buying. So even if you don't want to listen to the two of us talk for 90 minutes, you probably want the bonuses.
Yeah, and then Katie goes to ask, are they planning to schedule a seminar on a weekend or during non-evening hours? I think that's a good idea, to be completely honest. So we'll talk about that, Katie. We'll figure out something, and then we will have an update for you next week. How's that? We'll put a plan together and figure out what we can do there. All right, Josh. Mr. Peter says, just did a refi. Oh, well, he just has a comment. Did a refi with Josh. Super impressed with the service provided. Refinanced a non-QM loan, spending the extra cash on a GX.
I've seen
GX
that.
what, 470?
Yeah, they have new numbers now. I'm not sure if it's a 470, but the GX is pretty sweet. I'm trying to talk him into sending it out to Phoenix to Westcott Designs and have them put the big lift and 37s on it. He and his wife are thinking no, but I'm saying we had some nice savings from that refi. Let's really put it into the ultimate GX.
There you go. The new body style is rad. It looks good. All right. Let's see. So Josh, not a lot of questions coming in. I'm gonna tell a little success story here for a second. We did a webinar back in January, the same one that we did yesterday. Yesterday, we fine-tuned it a little bit based on the advice and the feedback that we got. We went into more detail about the actual execution, the process of buying a house. Once you get pre-approved, we talked about what the next steps. But back in January, we did a webinar and we had a couple hundred people on that. And out of that, 4 people actually have now successfully gone into contract. And how many have closed, Josh? I know we got one closing, Soriano, Sue. When is that? That's probably next week. Or
3 closed, that one closing in the very near future. And another one, they have very specific needs. So they've found one and didn't win the bidding on that. And they'll probably be in escrow in the next 3-4 weeks.
So understand, the only reason I bring this up is because people are still buying homes, success stories out there. We're getting offers accepted. We're getting repairs negotiated. We're getting compensation covered. So there's a lot of things that people have questions about that are worried about that we're finding success around it. And one of our, like the clients that I'm helping here in Southern California, their offer didn't get accepted initially. There was another offer, but that offer fell apart because it was a 1031. The buyer couldn't perform. We were the backup. We came in, we've been able to negotiate. Josh is doing the loan. Everything's moving forward. So it kind of goes along with, the comment from Peter a moment ago, the success story piece of it. We're not only here to answer your questions, we're actually here to help you personally. So if you need a loan, you need a lender, reach out using that link below. If you need a real estate agent, I can help guide you through that process. I refer a lot of people to agents that I can't help. If I can't help you, I'm going to refer you to somebody that can. And then if I can, I'll help guide you through the process. So just wanted to go off the cuff there and mention that.
So a couple comments there, Jeb. One of the buyers closed in Maryland, and same situation. They put in an offer. They were not the initial offer accepted. That initial buyer kind of dicked around with their deposit, and the agent and the seller just said, "Hey, you're out," and we ended up getting that one. So take heart if you don't get your offer accepted right away. The right house will find its way to you. The other thing that I would like to say is, like, the greatest compliment that we get, I talk to people that call in all the time and they tell me, "Oh my God, I'm so stressed. I don't know what's going on. I'm supposed to close in a week. My loan never got locked. I haven't got disclosures yet," whatever. I have 1 or 2 of those calls every week. When we finish with these, the best compliment we get is most of these people are saying, "Well, that was a non-event. I thought it was going to be harder than that or more work." And that goes back to what Jeb and I presented last night. We have a system. I've done this is my 30th year in October. We've been 30 years of doing this. Jeb's more than 20 years. He and I have known each other.
Baby.
Yeah. He and I have been knowing each other since 2009 and working together since 2013, 2014. And we've built a system. And I'm not saying we're rocket scientists or geniuses, but a system where we're the experts that take the stress off of you and just make things move smoothly. And one of the slides we had last night that we presented was basically Jeb saying, "Okay, you have your appraisal, you have your inspection. Now there's some renegotiations there." And one of the steps was just be patient, just be cool. And here we are on one of these deals where we're clear to close. It's not supposed to close for 10 days. It's clear to close. We're ready to send docs out, but there were some things on the inspection and we're having those negotiations, but it's a non-event. Those people are cool. They're just chilling out. I heard Jeb going through the strategy with them. They're the manager. They're in the driver's seat on that, but he's saying, "Here's how I would handle it. Here's how I'd like to proceed. What do you think?" And they go, "Yeah, that sounds right. Let's approach it that way." So that's the benefit of having a system that works from A to Z and a team that knows how to run it for you.
All right. Enough. Here we go. Gerald, is there a such thing as a partial 1031 exchange? Meaning, can I reinvest only a portion of my gain from the sale of my property? And the answer is yes, but you're going to be taxed on whatever portion is not invested. Isn't that correct, Josh?
No? You can't.
You have to invest the whole thing?
No, it's a tax deferred exchange. If you touch any of the money coming out of it, you are going to get taxed.
But can't you put part of it in a 1031 and not put part of it in? I thought you could. Okay. So Josh is saying you can't. All right. If we find out differently from Chat GPT, we will let you know. So Josh, we're gonna say Josh is accurate because I questioned my answer and he seems confident. Question.
You keep going with questions. We're going to ask Josh GPT with citations.
All right, here we go. Question from my end. First time home buyer, really love the house. Really love the house. They dropped the price by 20K, so it's now 650. Thoughts on first time home buying now? That doesn't help me out. 20 grand, was it priced correctly to start with? Is it priced correctly now? Is it still overpriced? Is it undervalued? Like none of that means anything, unfortunately. And I'm not trying to be like, defensive about it. There's not enough information there. And at the end of the day, it's not really about the price. It's about whether or not it's the right time in your life. And if it's the right time in your life, then you got to figure out the price. But if it's not the right time in your life, then the price doesn't matter. How's that? Josh, you're gonna have to jump in on this one. I'm sure of it. But Chris works for a company, but has his own business on the side. What's the best type of loan for me? I have $200,000 saved for a down payment. So a little bit of self-employment. Sounds like also an employee. What are we talking about?
Just depends on if we need that self-employment income and how it looks. I have conversations. I had a past client reach out to me. They wanted to buy a house down the street. She goes through her income situation. They wanted to keep their current house. And I look at it and I go, can't do it. We're going to need your husband's income. Okay. I'll send you over the tax return. He's self-employed. So, okay, cool. How much money did he make last year? Maybe about $158,000. Get the tax return. He lost $6,000. Top line, $158,000 came in the door, but then we had $70,000 in cost of goods sold. So there's actually $80,000. And then we had $85,000 of expenses. We lost $5,000. We're worse with him on the file than with him not on there. So a couple pieces there. Do you qualify with just your regular working income? Does your W-2 income allow us to get you qualified for that? If so, then we just ignore the rest. And I have people like that all the time. They got a side gig, they make $10, $20, $40,000, but we don't need it to qualify. And it just makes more work and effort and energy to document that self-employment income that we don't necessarily need. Now, if we need it, we got to ask, are you in that same situation where it brings in a bunch of money, but actually shows a loss on paper and shelters some of your W-2 income? Because if so, then that's not really going to help us. And if we need it, we do have options. There are lenders that will allow us to do like a hybrid bank statement loan where we could do bank statements for the business portion, where we can show your business bank account averages, $8,000 a month in deposits. They're going to apply an expense factor to that. 20, 30, 50%. Say, okay, cool. There's $4,000 of income. We can put that with your $100,000 of W-2 income. It's still going to get priced like a bank statement loan, kind of lowest common denominator, but there are those sort of hybrid options. So to just answer with the little bit of information that we have right now is impossible, because what is the best loan for you depends on which of that income do we need to qualify you for what you're looking to buy.
And Chris, you mentioned you're in Orange County earlier. We're in Orange County, obviously. jebsmith.net/start. Fill out that link. Josh and the team can reach out to you, have that conversation. Obviously, no pressure, no sell. It's not a high pressure situation here. It's literally a conversation to see whether or not you can do it and if it makes sense, and go from there. So Katie says, is it worthwhile to add details to your rate watch as soon as you close on a home, or should we wait X number of years from buying the home? Oh, so basically, or should we wait after a certain period of time after buying a home to get on the rate watch? So Josh, once you're on the rate watch, do you need details added to it, or?
Well, I mean, we need the details of your current loan. So if you know what those are, they're not going to change. We want to put it on there. My clients, when we close the loan for you, the system that I use for the rate watch, it pulls their details in automatically. So from that perspective, we're watching for them from day one. And I would suggest the same for you. It would have been even better. We could have closed that purchase loan for you, and then you would just automatically be on the list. You wouldn't even need to worry about it. But either way, start earlier rather than later. That loan for Peter, who was just here a second ago, we literally had to wait. We could have closed that last Wednesday. We had to wait till today because the lender that he did that purchase loan with would have been subject to an early payoff penalty because it was 180 days last Thursday. So we waited till now. So there was no negative repercussions for them, who happened to be a family member of his. And then we were able to close on that today. So that is how fast these options come up. We've had that situation. We had a listener to the show, Bronson, down in San Diego, that we refinanced his loan 3 months after he closed, because rates moved that much between last July when he closed and September when you saw on that chart the bottoms. So it's rare, but sometimes does happen where you need to move quickly.
Review Bruh says, are you both real people? And we are for now, until ChatGPT and the AIs take over. We are both still here and real people. It could change.
Jeb, I meant to send you a video last night because you talk about the AI. I saw a video on YouTube and I'm like, this is clickbait. This guy's just making something up. But he literally went and dissected a marketing campaign. There are companies that are importing cheap dog shit imports from China, which will stop with the tariffs. But they are making AI pictures and ad campaigns, making it look like there's these old people who are handcrafting handbags or watches or whatever this thing is. And they're old, they're going to retire to spend time with their grandparents. It's an elaborate campaign. And then they have reviews, video reviews. And this guy was awesome. He goes in, the video reviews, he found all the actors on Fiverr that got paid $5 on Fiverr to read a script. Like, it was that in depth. So AI little faces, AI story marketing campaign.
Genius.
So be careful. We too are real people, but if you see of a retiring realtor going off to not do loans because he wants to spend time with his grandchildren, be careful. Those guys may not be real.
Josh, can you recast a DSCR loan?
I don't see why not. There's an important distinction here. Many of those DSCR loans, I mean, some are done as a 30-year fixed. I just did one for myself as a 30-year fixed. But a lot of those are ARMs. You don't need to recast an ARM because the ARM can adjust up and down the interest rate every month. They're having to do that calculation and figure out what does next month's payment need to be to pay this off over the remaining life of the loan. So no recast required on an adjustable. It is on a fixed rate. But the DSCR, those are private loans. They don't really go into Fannie Freddie pools. They're in private mortgage-backed securities. So the servicer doesn't have to agree with that. But unless they want the entire loan off their books for you to go and refinance it, they probably would cooperate with it.
All right. I don't understand this question, Josh. Perhaps you might. Gentlemen, is there a way to relate mortgage underwriting and loan sharking in the essence of funding an escrow account, especially if there is no gray line in the fine print of a written official document?
I am going to open the door for Sam to come back and clarify, because my initial response is there's a tiny subset of people who are insane and triggered by an impound account and think this is a horrible, terrible, crazy thing. There are details and laws. So I don't know if you've dug through something and said, oh, this is terrible and I'm being taken advantage of. Had a listener that we're getting pre-approved and she's putting 30-40% down. And she was asking, why I wouldn't want them together because I got a high yield savings account and I'm getting 5.5% on that. And I said, okay, well, let's say on the high end, your homeowner's insurance is $150 a month. So at the beginning of the year, there's $150, then $300. So the average balance on that $1,800 the course of the year, let's call it $900. So you lost $65 from your high yield account, but you had to remember to pay that and deal with it at the end of the year. The taxes, she was in a lower cost tax state, and it was going to be like $250 a month for the taxes. So like maybe you lose $80 at the end of the year. So if you think $150 is worth the hassle of you having to pay your taxes, property taxes twice a year, you have to remember the renewal on that. That's a personal decision, and I'm totally okay with that. But anyone thinking that this is some sort of scam or that lenders are getting rich off of it, obviously there's a big float there, because what I can tell you is we just had a listener that we closed a refi on that their servicer showed the money out of their impound account on like February 17th. In California, they're not late until April 10th. You'll be shocked to know that the money showed up at the county assessor's office on April 10th. So they do want to keep that money there. It's millions of dollars for them. They can probably invest it safely and get a nice yield on it. For you, it's a rounding error. But if that's your preference and you want to take on that work for that small reward, totally cool. But anyone looking and trying to see something, impound accounts and loan sharking, yes, they're the same thing. I agree.
All right. I'm going to jump to this question real quick. MF says, I saw an old video of yours arguing against pre-inspections when listing your home. Do you still feel like pre-inspections are a bad idea? I personally, as a listing agent, don't like pre-inspections. Buyers buy emotionally, they justify logically. When you set something, a home inspection in front of a buyer who has never, they're maybe the first time ever seeing a property, their first time home buyers, everything looks like a problem. Even small things look like a problem. Problems can look like problems without context, without truly understand what's going on. And I think what happens is a lot of times when you give somebody a pre-inspection to a property, they overanalyze, they overthink things, they whatever, versus actually falling in love with the property and then coming back and having an inspection where an inspector can walk you through the things personally. It's a completely different experience. At the same time, a pre-inspection, if your plan is to do a pre-inspection because you want to get it and walk through and do all of the repairs, I also think that's a bad idea, because oftentimes buyers don't ask you for all the repairs. The buyer might ask you for different things than you think are important. You're spending your money on these. The buyer cares about these. And then you've just spent this money. Now the buyer wants these repairs done. And your argument is, well, I just spent all this money doing this. Well, they don't care. So I can see a world where people think they're a good idea. And for some agents, I think it's by choice. But me personally, once you do an inspection, you're required to disclose everything that you're aware of. Doesn't mean you're hiding anything. If you don't know it, it just means you don't know it. And I like to take that approach as a seller, versus the let's open the kimono and give everybody everything up front and let them decide from that point forward. Because most people aren't going to come into the process and release all contingencies anyhow. So you're still going to have something to allow them to back out. So I think it's better to do it after the fact. Just my 2 cents.
I think, Jeb, there's a sort of a corollary to that goes along with what you just said. Sometimes people will do a home inspection. Major issue comes up and the seller goes, I don't think it's a major issue. I'm not paying anything. The deal falls apart. Now, again, they didn't know about it. They can say they didn't know about it. Now there's an inspection. They didn't pay the inspection. It wasn't theirs, but it was brought to their attention. They were given the inspection and said, here's an issue. They have to disclose that to anyone going forward. So
Sure.
It's funny how often I hear that the seller says, no, this is ridiculous, and they'll just find someone else that doesn't care about it. But Jeb, did you want to proceed to the Josh GPT portion of the night that's going to be your favorite part that proves that Jeb was right and Josh was giving incorrect answers?
No, I just want to know the actual answer. Let's
100%.
go back up.
So going through it, you will pay taxes on anything that isn't rolled over, but a couple good cited sources here that you can do a partial 1031. Any amount not reinvested is called boot, and it's subject to capital gains. So you absolutely can do what the question was asking and suggesting and roll over a portion and keep the other portion and get taxed on it.
I think I've had one of those in my back at some point in the past. That's the only reason it even registered, but I can't recall it. So good to know. This kind of goes along with capital gains as well, to some regard. Back to the 1031 exchange question. If I have a significant gain on the sale of my home and I paid cash for the next home with a portion of the gain, am I taxed on the entire gain or the portion of it? So when you have a 1031 tax exchange, and like Josh said, right, all of that money is taxable because it's a 1031, right? It's not capital gains on your house, right? If it's a primary home, you can roll part of that over and not be taxed on it. In this case, if you rolled part of that over into a new property that's an investment property, then in theory, that shouldn't be taxed as long as that's a like kind investment. Whatever portion you didn't invest, based on what we just heard, is taxable. Am I missing anything there, Josh?
Let's step back and tell me how you're reading this. So significant gain on the sale of my home. So paying cash for the next home doesn't matter. What you do with that, if you sell that house, that is going to create the taxable event. What I often hear people saying, hey, I paid my house off and it's worth $1 million. If I sell it, do I get taxed on that $1 million? No, you get taxed on the difference between the $1 million and your basis in the home. So your basis is what you paid for the home plus certain eligible improvements. And then what your profit is not what you sold it for. It's expenses in selling. You pay a realtor, you pay closing costs, all of that. So for an individual, up to $250,000 of gains on something that you've lived in 2 of the last 5 is free. So From the other perspective, if you're married, you've got up to 500,000 there. So for most people, this is never an issue. But if you take that money, whether you buy another house or not, doesn't matter. And if it was your residence, it wasn't an investment, you cannot do a 1031. The only way to do a 1031 exchange is to convert it to a rental for a period of time, then do the 1031 exchange. Right. So obviously you have some complexity there to your situation. Check with a tax advisor, a tax professional.
For sure. My favorite comment of the night, maybe the month, Josh, the guy with the hat looks so angry. That's fantastic. Thanks, Robert. That made my night. I'm going to go to bed smiling because I think it's fantastic. Alex asked a similar question 3 different times in 3 different ways. So I'm going to find one from previous because we were going to answer it, Alex. Just give us some time here. We got a lot of questions. Here we go. $120,000 left on a $225,000 home. Would you try and pay it off to use it as leverage on a HE loan or cash out refi later, looking to pick up an investment property in a year, 6.8% interest rate on that property? So Josh, what would your plan be if you had 50% equity in a property? Would you just pay that property down, or would you save the money to put down on it?
Let's just look at the first part. So this, like, I'm honestly, I'm confused by the question, because saying, would you pay it off to use it for a HE loan or cash out? So if I'm going to get another loan, why would I pay it off? Once the money goes into the house, it is trapped there until you get another loan. So stay liquid. I understand the idea. Hey, I'm not super stoked with this 6.8% interest. But from that perspective, it is what it is. I would rather stay liquid. If your comfort level is paying it down, cool. But why would we pay it down if we're going to do another loan to get that money back to invest in another property? And then looking to pick up an investment property in a year, you don't really need to do anything right now, unless you think rates are going to be significantly higher next year. I would hang out. I would throw my money into as high a yield as you can get. I haven't looked. What's the most recent best online money market? Jeb's like 4.5%. That's probably what I would
somewhere
do.
In there. Yeah,
that's what I would do.
All right, good stuff. Hopefully that was helpful for you. Joyce, just coming back to the pre-inspection question, said pre-inspections invoke the idea of getting attached to a house as a first-time home buyer. Have you seen real estate agents use pre-inspections in place of regular inspections later on to hurry up? And she goes on to say the timeline. I haven't really. We don't see a lot of pre-inspections in our market. San Francisco, for example, during the pandemic was a big market where there were pre-inspections done. In fact, there were full home inspections done. I'm still calling those pre-inspections because it was, prior to a buyer coming in. All disclosures filled out, title report pulled, everything is in a file. So you're reviewing that prior to making your offer with the idea that I've seen everything. I'm going in. I know I'm going to buy this house. I can make a strong offer without having contingencies. That's typically the idea around some of this stuff. The idea, again, with a pre-inspection is, hey, I'm showing you the issues with the property so that you don't come back later on and say, well, I didn't know that was wrong with the property. My argument is, even if there's an inspection done on a property, I think as a buyer, you should do your own inspection. Unless we know the inspector, unless we have, we can walk the property and feel confident in that inspection. Different inspectors, believe it or not, will walk through a property. Some will pick out some things, some won't pick out the same things. It's one of those just kind of weird things that some people are super detailed, others aren't quite so detailed. So it's to each his own, but I would either way just get an inspection on a property and feel confident in the inspection, regardless of whether it's a pre-inspection or one during the property. But if I'm selling a home, I'm not doing a pre-inspection. Josh, difference between standard home insurance versus fire insurance for those looking to buy and stay in California in high risk areas. Is there a difference in the two?
The first temptation is to say, no, it's the same thing. But he's specifically asking in California high risk fire areas, and then they can be separate. If you're buying in a normal part of the country, or even in California with not a normal high risk area, you're going to have one insurance policy. It's going to cover a tree falling on your house. It's going to cover a fire coming through and burning your house down. One coverage, one and the same. What we do have is, let's say you get pushed to the California Fair Plan. That is a limited type of policy that really only covers fire damage in a high risk area. So in that case, you would have a separate policy that covers your contents, liability, all of that fun stuff. So if you're in one of those areas, you may end up with 2 policies. But if you're in a normal area anywhere in the country, you're just going to have one policy that covers fire and normal hazards.
All right. Vag Sports Highlight says, can 1031 money be used to buy multiple rentals? And the answer is yes. Again, as long as it goes from a like kind investment, say, residential property to residential property, you can buy it however you want. You can buy, you can sell one property, buy 10, you can sell 10 and buy one. It's all how you want to do it. Josh, you're asking a question here that you went to an
I wanted to
open
know the answer.
house the other day, and one person with the realtor commented, "If you like the house, we can buy it for you, and then you pay us for it." Never heard of this before. What's your take on it? My guess.
Follow up, just for context, good houses selling within 5 to 15 days. I'm guessing a way to beat cash buyers.
Yeah, I mean, the only time somebody's offering to buy a house and then you buy it for me is typically it's like, the parents, the grandparents, somebody there is helping out. I do know there are companies out there, if you're trying to do a contingent offer, that sort of thing, that they'll buy the house, allow you to sell your house, and then you can buy it from them with some sort of markup. I mean, I don't know. I don't really get the the need for that in most markets out there at the moment. If it were a super aggressive market, then maybe there's a world which that exists. But even then, there's some markup. I mean, like, who's going to buy a house cash and just give it back to you at the same price? I mean, that there's cost to that money sitting there. There's transaction cost. There's other things
Yeah,
happening
the
that
transaction
need to
costs,
be
you end up with
factored.
dual costs. They're
Yeah.
having to
So
pay their costs, and you're going to pay them too.
I don't really see the need. I mean, I've never seen a seller shy away from somebody coming in with a loan. Cash offers are cash offers, but you can beat a cash offer with a loan. I mean, cash offers are only great if they're really the best offer in all terms. And typically speaking, they're not. I mean, sometimes they are, but not always. So don't shy away from cash offers, because again, rarely are they the best offer. Steve says, what information do you need to compare your loan between lenders? Really good question, Steve.
You can't tell them
Josh?
it's a really good question and not answer it. You thought it was a great
What?
question. Give him
I
the
did. I mean,
answer.
I could answer it, but you're the lender. You answer it.
Here's what I would say. If you've talked to multiple lenders and your concern is comparing the actual numbers of them, you haven't talked to the right lender. The value of a lender, we went through this on the webinar last night. Reputable lenders should be in a very narrow range of interest rates. The more important thing is getting you in the right loan program. The right loan program, the right cost structure is going to make a much, much bigger difference to your wealth building over the long haul. Having that structured process where all the stress is front loaded, we have everything. We got a rock solid pre-approval. So going through the process is easy and stress-free for you, a timely closing. So you're not one of those people calling me throughout the week in a full-blown panic because nothing went the way that it was supposed to. That value, easy for me to say here, but is 10x worth trying to find $500 in closing costs or less than 0.1% in interest rate. To compare the options, you want either a loan comparison worksheet, a fee worksheet that shows you all of the costs there and the interest rate that they're quoting you. And they should be able to simply tell you what's the interest rate and what are the box A fees, because on a purchase, the box A fees are primarily the only things that your lender controls. They have some impact on box B, but I mean, plus or minus from any lender, the worst to the best is maybe $500 in box B. It's probably more like 100 to 200. So box A is where the biggest difference is going to be. That's where origination fees, discount fees, application fees, technology fees, processing fees, anything that they want to charge. And I don't care what they are. Don't get hung up on what the name is. Look at everything in box A, call that the points, the origination fee, the cost of the interest rate. So for $1,500, $1,495, I get 6.99%. Because what I get all the time is, oh, I got a better offer. Cool, let me see what it is. Well, this says 6.49 and you're paying $18,000 in box A. Did you want to pay $18,000 in box A fees? No, but I wanted a lower interest rate and they said they could get it for me. So really someone who can walk you through all these nuances and explain those things to you is far more valuable than calling a bunch of lenders, going through the paradox of choice, getting confused, being sold by multiple people, and then going, well, which one is going to save me the last $100?
All right. Let's see. Salma asked this question a little bit ago. Says, thoughts on Beverly Hills single family market, homes under 3 million. Are prices expected to decline and inventory increase. So I think Beverly Hills is one of those markets that's pretty protected for the most part. Not a lot of buildable land, pretty insulated in many regard. So I don't work that market specifically, but I got to think if you're under 3 million in Beverly Hills, you're at the lower end of the price point, which basically means there's probably a lot more buyer demand than there are properties available at that price point. So I don't see a world in which you see a real decline in prices there personally. But that's just me speaking. But if you do need an agent that works that market, I do have a friend, a colleague that works up there. Happy to put you in touch with somebody if that's your market. Josh, how about them Clippers?
Ask me Saturday night.
Ask him Saturday night. That's what we're gonna do. We're not even gonna. Sorry, Wesley. He's brushing you off, man.
Wesley, this time next week, we're all going to be real happy to be Clipper fans. We're going to be sitting around waiting for Oklahoma City to finish their series. Actually, Oklahoma's probably going to finish theirs before we do.
I'm not truly understand the question, but can one of you please tell me the value house now in Sacramento and Roseville, Placer County? Not 100% sure what you're asking directly, but if you need an agent in those markets, I have a great agent that works that area. Happy to refer you to her and her team, and she can guide you through the process. She's helped a lot of people here on YouTube, that I've referred up there. So,
lots of them. We've closed loans with them on several occasions. They do a great job of managing that process for you.
Good stuff. Josh, we're towards the end of questions that we have here at the moment. I'm just going to ask you again, Josh. Hold on, one more time. How about them Clippers?
How about them Clippers? Well, Wesley believes, but more importantly, where has Wesley been for the last 8 months? He popped up in the comments section last week, and I had to ask him. I go, I thought you caught a stray. Something bad happened. You just disappeared. We hadn't seen Wesley in like 6-8 months.
He's been praying for the Clippers. Yeah, he's finally back.
Steve knows that Clip City, Chip City. That's right. That is right.
Oh, you guys, here we go. You and your professional basketball. Worst sport on TV, right behind bowling.
You watch a lot of bowling?
College is where it's at. You
guys need to come up with a question because we're losing viewers here left and right.
Well, we're talking about the Clippers. Of course we are. Let's see. I mean, he has a solid point here.
Wesley says the housing market is more fun if you only check in on it once in a while. That is a healthy approach, Wesley. And we don't like a healthy approach. We like a rabid, unhealthy, out of your mind approach to everything.
Well, so with that, guys, what we're going to do is we're going to wrap this thing up. We will be back next Wednesday here to answer your mortgage and real estate questions. Check out the podcast this coming week. We have a great episode coming out on Monday. With that, make sure you're buying right, borrowing smart, building wealth. If you need us, use that link in the description. Till next time, adios.
Amigos.